Okay, so my beloved clients and friends, we're on to part 3 of this 3-part series that we're talking about first principles of investing. And we talked about what investing is. The purpose is to grow and preserve your wealth over time. And we talked about an example of what it would actually look like. And the thing that gets people is even this type of portfolio that we're talking about, every day the price goes up or down, and sometimes it goes up or down a lot, and sometimes it gets locked into a period where it's generally going down for a while. Like recently we were in a 4-month downtrend in the portfolio, and it's happened before and it'll happen again. So what causes the price to move so much? If you're buying great companies, like you say, and they're growing, preserving your wealth over time, and didn't feel like it was preserving my wealth over the last few months. So companies have a value and they also have a price. Okay, and let me give you an example. Let's say I owned a McDonald's. Okay, and if someone were to ask me, what is your McDonald's worth? There's basically 3 ways that I could answer that question. I could say, well, you know, I paid $1 million for the land. I paid $800,000 for the improvements to put the building on it, and I spent $200,000 in equipment, and I have about $20,000 in inventory, and I have about $2,000 in the cash register. So you say it's worth a little over $2 million, right? Or you could say, well, last year I had a million in earnings, and they go for about 2.5 times earnings, and so it's worth it's worth about 2.5 million. Right, so those are 2 ways to value the company, price to book, and then the other one is some type of multiple of earnings, right? And a third way that an asset could be valued, like a bond, for example. Let's say you had a 3-year government bond paying 5%, and you had put $100,000 into this government bond. And so next year it's going to pay you $5,000, the 5% interest. And in 2 years it's going to pay you again $5,000. And in the 3rd year it's going to pay you again $5,000. Plus you're going to get your 100 back. So what is that bond worth? Well, $5,000 a year from now is not the same as $5,000 today. Right, if I had a buddy that said, hey, let me borrow $100, I'll pay you back tomorrow because I'm getting paid. I go, yeah, sure, here, no problem. So I give him 100, he gives me my 100 back the next day when he gets paid. Then a couple weeks later he goes, hey, let me borrow, let's say Tuesday or Wednesday. He says, hey, let me borrow $200 and I'll pay you on Friday when I get paid. I go, yeah, sure, here's $200. He pays me my $200 back on Friday when he gets paid. And then a few weeks or months pass by, and he goes, hey, let me borrow $500 and I'll pay you back next year. I'm like, wait a minute. Right, what would you say to that? Like, you're going to hold my $500 for a whole year. I'm going to lose the interest on that or whatever. I could have done something with that. No, if you want $500 in a year, you better pay me back with interest. Pay me back $550, and then it's a deal, or whatever, right? But so there's a time value to money. So going back to that bond, it's going to pay me $5,000 a year from now. That $5,000 is worth less in today's dollars because there's a cost for that money. So let's say that one a year from now is worth only $4,500. And the one 2 years from now is really worth only $4,000. And the one 3 years from now is worth only $3,500. And that 100 that I'm going to get 3 years from now is really worth only 80, right? So you could say that bond, that $100,000 bond that's going to pay $5,000 each year for the next 3 years, is really only worth about $92,000. That's called the discount cash flow method. So those are 3 ways to value an asset. And you could, I mean, you don't get it to the penny value, but you have an idea, right? So because I own my McDonald's, and I figure, well, one way I calculate it, says my McDonald's worth $2 million. The other way I calculate it says my McDonald's is worth $2.5 million. So I have an idea in my head what my McDonald's is worth. Why this helps me is, let's say someone walks into my McDonald's and says, hey, I'd like to speak to the owner. I say, I'm the owner, how can I help you? He says, I'd like to buy your McDonald's. I'll give you $1 million for it. What would I say? Well, I know in my head it's worth between 2 and 2.5. So I'm like, thank you, sir, but no thank you, right? Let's say the next day, someone walks in and says, hey, is the owner here? It's a different person. He says, I'd like to talk to the owner. I say, I'm the owner, how can I help you? And he says, I'd like to buy your McDonald's. I'll give you $5 million for it. And I'm thinking, well, shoot, for $5 million, I could sell this one and buy 2 more, because McDonald's is worth about 2.5. So I'm like, sure, I'll take it from you. I'll take your $5 million for you. Here's the keys, right? So did I get super depressed when the guy offered me $1 million because, oh man, my McDonald's is only worth $1 million. I lost $1.5 million, or $1 million $1 million because I put $2 million into it. Oh, I lost money. You didn't lose money. That was just that one person's opinion, and you could take it or leave it, right? When the guy offered you 5 the next day, do you think, shoot, my McDonald's went up $4 million in one day. I should hold on to it because tomorrow it might be worth 10. No, you realize that was a ridiculous high price. I better take it because that guy doesn't know that it's only worth 2.5, right? What if they would have come in on the opposite days, and all of a sudden, one day you hear 5 and the next day is 1? Do you think, oh man, I lost $4 million in one day? All that stuff doesn't matter when you know the value and you don't worry about it. And that's what the stock market is. All it is a quote of what somebody paid for that stock most recently. They may or may not know what they're thinking about. I mean, they may not or know have an accurate valuation of the value of that company. And that happens all the time. And it happens because of 2 things: fear and greed. People get super excited, emotional, and they'll bid something way up above what it's worth. And then they'll get super emotional to the other side of fear. And they won't pay nearly what something is worth because they're afraid to let go of their money, right? So when you understand the value, you could keep your cool when prices are low and say, well, shoot, this represents not a time to panic, but a time to buy when prices are ridiculously low. Because, what that guy that offered the $1 million was thinking, I might catch this McDonald's owner on a bad day and he's fearful or panicking, and he might give it to me for the ungodly price of $1 million. And that happens sometimes, right? So why not ask? And that happens in the stock market. And sometimes people get so excited and they'll offer $5 million for a $2.5 million McDonald's, That happens in the stock market too, all the time. So when you don't know the value and all you're looking at as the price, it'll make you super confused and make you make bad choices. Like if one day someone offered you $1 million and the next day 5, you might hesitate to take it because you see a pattern. It went from 1 to 5. It might go to 10 and 20, but of course it won't because it's only worth 2.5. Or you might get super freaked out when an offer one day was 5 and the other offer was 1. You're like, I better take that 1 because tomorrow I might get nothing. Right? Why would you panic at these random people walking in and selecting, offering you a price, right? Benjamin Graham magically called that Mr. Market. This guy that every day he offers you to buy or sell you a share of your securities. And if you don't know the value, you're going to get whipsawed by emotions. So what causes price movements? In the long run, the price of a stock is pretty close to the value of the stock. It tracks it over a long period of time. And if you look at long charts of the stock market, like I have one in my office that goes back 100 years, and you step back a little way and it looks like just almost a straight line over the last 100 years that went up and to the right. But there were times when there was big runs up, and there were big price drops. But over time, the value of those companies have gone up, and over time it looks like a straight line. But in the short run, why is there so much price movement? So in the long run, price equals value. In the short run, price equals value plus emotions. And when emotions are high and positive, then the price is higher than the value by the amount of emotions, of excitement and greed and optimism, right? And when emotions are negative, fear and doubt and uncertainty, then the price is value minus all that fear and doubt and uncertainty. And guess what? It changes from day to day. Right? One day they say, oh man, Putin wants to talk and the war might be over and the stocks shoot way up. And the next day they realize, oh, that's what he said, but he's actually bombing Kiev, and then stocks go way down. Because on a day-to-day basis, emotions move the market. Over time, they do not. They wash themselves out. Okay, so you could use that to your advantage and it's a great thing to be in the business when your counterparty is emotional. Imagine working at a pawn shop, and you'd do very well if you were very unemotional, because people walking in the door, guess what they are? Very emotional, right? They're desperate and they're emotional, and they want to sell something. So you could calmly say, yeah, I'll take that price, or no. And you have the advantage because you're the unemotional one. Well, the stock market is very much like that. They're not patient. They're not disciplined. They do not harness the emotions, and they don't think for themselves. And so if you can do those things and your counterparty does not, it puts you at a distinct advantage. Okay, so that's what causes the price movements, and we welcome an environment where there is those price movements because it gives us the opportunity oftentimes to buy really low and sell really high, buy for less than it's worth and sell for more than it's worth, if we start to try to understand what it's worth. So when it's way down, we get excited because, wow, they're really going to let me buy this thing that cheap. And when they get real excited, and we could stay calm and say, they're really going to give me that much for this, we don't get too excited either way, and we're able to use those price movements to our advantage. So that's a little bit about how what causes those price movements in the markets, and why not to get too concerned about it, and how to actually use it to your advantage. So I hope that was helpful. Hope you guys have a great weekend.